loan-to-value ratio, or LTV, that is the maximum percentage of a property's value that the lender will lend. The LTV, or loan-to-value ratio, determines the amount of the loan and whether the borrower will have to pay private mortgage insurance, or PMI, or in the case of an FHA loan, they call it MIP, mortgage insurance premium. LTV is always based on the sale price or appraisal value, whichever is less. The lower the LTV, the greater the down payment required. Private mortgage insurance, PMI, is normally required by lenders on conventional loans with LTVs higher than 80%. If the borrower defaults, PMI, private mortgage insurance, helps protect the lender against loss due to foreclosure and covers the difference between 80% LTV and the LTV percentage of the actual loan. PMI, private mortgage insurance, is paid by the borrower. PMI allows lenders to provide loans to borrowers with LTVs higher than 80%, which translates into lower down payments. The higher the LTV, the lower the down payment. PMI automatically terminates if a borrower has accumulated 22% equity in the home and is current on their loan payments. The mortgage insurance premium, or MIP, is similar to PMI, but it's for FHA loans. If the borrower defaults, the MIP in an FHA loan helps to protect the lender against loss due to foreclosure, same as the PMI, and covers the entire loan balance, same as the PMI. Unlike PMI, though, the MIP, mortgage insurance premium, is paid by the borrower for the entire life of the loan. It doesn't automatically fall off at 22% equity. Equity is the difference between what a property is worth and what is owed. Equity means market value minus total debt. The difference between what you owe and what a property is worth. Points on loans are something else you need to be reminded of. With points, lenders charge them to increase their yield or their profit on the loan. The cost of 1 point is 1% of the loan amount. So a loan for $100,000, if that borrower were to buy 1 point, that point would cost him $1,000, 1% of the loan amount. The loan origination fee is what the lender charges to process and issue the loan. Leverage is the use of borrowed money to increase returns on investments. The advantage of using leverage is the borrower can control a large asset with very little of the borrower's own money. The disadvantage of leverage is the higher risk of default. The lower the borrower's equity, the higher the risk of the borrower defaulting. Interest is the percentage of profit the lender wants in return for using their money. It's basically the cost of using the money. That's interest. Usury. Usury is a fancy term basically that means loan sharkery. Usury is when a lender charges an illegally high interest rate, higher than what's permitted by state law. That's usury. Loan sharkery. Payments on real estate loans usually consist of principal, interest, taxes, and insurance, or PITI. PITI is the monthly payment made by borrowers that includes the debt service, which is the principal and the interest on the home loan, plus 1 month's worth of property taxes and 1 month's worth of homeowner's insurance premium. Lenders require a borrower to acquire and maintain a homeowner's insurance policy. Hazard insurance. Hazard insurance covers damage or theft in an amount equal to at least 80% of the replacement cost of the property. To finance property with federal or federally related loans, owners in flood-prone areas must also obtain flood insurance. Subordination. A subordination clause is found in some promissory notes, allowing another lien holder to take a higher priority in the public record. Usually, what they call a second mortgage or home equity line of credit, they always take a second place. They subordinate to the first loan or first deed of trust loan.